What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves. 45 days. Free. No risk. No friction. Just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome everybody to episode number 44 of Sparta Market Outlook. I'm here today with our good friends Jorge Molinero. Hi Jorge, how are you?
Hi Felipe, I'm very good, thank you.
We also have our fuel oil guru, Hua. How are you, Hua?
Very good, thank you. How are you doing?
You've noticed I did not even try to pronounce your last name, as I will be butchering it, like you will probably be butchering mine. But how do you say your last name, by the way?
It's Nguyen.
There you go.
So you go up and down and up again.
Life is too complicated.
Still can't do
it.
it.
You gotta try, Philippe.
When?
Not too bad. Yeah, it's
Not too bad? Okay.
I'd say 80%.
I'll tell you a quick anecdote. It will bore everyone that is listening, but so my last name is Dutch, but I obviously don't speak Dutch, and I pronounce my last name Elink Schuurman all my life. And the first day I went to work at Nerevco, the refinery, I introduced myself. They were like, "So what's your name?" And I pronounced Elink Schuurman, and they're like, "Dude, that's not the way you pronounce your last name." And so I only realized when I was sort of like 25 or 23 that I did not know how to pronounce my last name. And even today, when I say it to Dutch people, they're like, "Nice try," So very embarrassing. Anyway, this has nothing to do with oil, with commodities, with trading. So I don't know. I'm just going to shut up from now on. Just let me introduce Neil, and then I'll shut up. Neil, how are you?
Yeah, all good. No troubles with last names.
Yeah, easy one. So a lot of headlines, I would say. Let's start with the headlines. That's a big event, a lot of events this week. Neil, maybe you want to start with that and give us a rundown of all the things that are happening or that could potentially happen.
Yeah, it's mostly bullish, I would say, or theoretically bullish. So just last night, there's the threat of conflict in the Middle East rearing its head again. So there's reports of US embassies getting evacuated in Iraq. There's a lot of rhetoric, basically, between Iran and the US and Israel. And it's hard to say what's going on, but it's definitely supportive for flat price, and Trump obviously saying things like he's less confident on a deal, which I think we talked about last week. It's safe to say it's very rhetorical, right? Some people asking me yesterday, do you think there'll be a shooting war? Yeah, who knows? But it definitely gives you pause for thought when you're looking at Brent spreads, which are, closing in on $1, and you're thinking about shorting it. It's difficult when you start to see those kinds of headlines, right? It just makes life difficult for you. So that's going on. What else was there? There was.
Is the market? Was the overall positioning short in the market right now recently?
I'd have to check. Not particularly is my impression. It was shorter a few weeks ago. I would have to check that, if I'm perfectly honest. I could be talking nonsense, but I think that's what it was. Yeah, it's just difficult at the moment. I mean, most people are now asking me, we can get onto this later, when do we short this thing? And flat price and spreads and stuff like that. But let's talk about that in a minute, maybe.
Yeah, we'll talk about that later, yeah. Mm-hmm.
The second thing is the US-China deal, right? Deals. There was a funny comment I just wanted to bring up which kind of summarizes very nicely. It's this guy, Paul Donovan, who's I think he's like the head economist of UBS. I think that's the one. And he said the deals summarized yesterday. The US side agreed to ask Trump to agree to revert to the Geneva Agreement that agreed to calm tensions while a trade agreement was being sought. So that was like a perfect summary of what's actually going on. And I believe there was some movement yesterday on sort of key minerals deals and things like that. But it's really there's a lot of hot air in the headlines as well. But, it's all these headlines are supportive for price when they're vaguely bullish for macro, right? That's what's been going on this week. The next thing is, and I'll just try and fly through them, there's been a lot of news this week, and it kind of confirms what we were talking about last week, which is that the wider market has caught up to the reality that OPEC hikes are not really OPEC hikes yet. So, now the flows are starting to be seen, physical flows, and some of the official supply numbers are coming out for April, May, June is due. And it doesn't look anything like what it should be on paper yet. And you're even starting to get some bank research saying, we've seen no signs of a hike in OPEC supply yet. And we've been talking about that for a number of weeks.
A quick question. What do you think would the actual increase in output would be eventually, say by the end of the year? Obviously, we talked about, there's a big difference between the quota and also the actual production, whether because some people have been cheating or, whether somebody is not, matching the production is not matching up to the quota. So what do you think the eventual increase will be by the end of the year? In my mind, I'm thinking probably closer to like maybe 300-400 KBD by the end of it, but curious what your opinion would be.
Yeah, it's a horrible question. I think you're probably on the right track because they want to unwind basically 2 million barrels a day of voluntary cuts, right, on paper. And even that timeline is being accelerated or decelerated depending on which headlines you read. And they've unwound maybe half of it by September type thing. But there's so many obfuscations, right? There's compensation cuts, and some of those things are actually working. So Iraqi numbers are coming down, Iraqi exports as well. Who are the people who can actually hike? It's basically Saudi. UAE is already much higher than quota. And, then there's a bit of Kuwait, maybe Russia. So, yeah, I don't know why. I think you're on the right track with, rather 500,000 barrels a day than 2 million barrels a day by the end of the year. But there's all kinds of headlines flying around, I think some of them have even been false. Saudi's asking for another 800,000 barrels a day in September. And then it gets rolled back because it may be unsubstantiated type thing. So the target's always moving, but it's definitely, we're on the right track by saying it's going to be less than on paper, certainly over the summer. And then I think now the question becomes just to, add to this, when is this narrative over, right? Because this trade has already been made. I think we had a good call the last month or two to say, hey, look, there's OPEC hikes, but they won't translate yet into OPEC hikes. And now the market is looking for a new narrative, which is why people are starting to ask me this week, when do you short this thing? Or is $1 backwardation justified now? And so we have to start now looking towards the end of the year. Crude burn will come down. At some stage, OPEC will have to show real supply hikes. Otherwise, it starts to look kind of silly, I would say. And I think that's not a fully fleshed out thought from myself yet, but we have to start thinking about, okay, at some stage, this narrative will change. Does that make sense?
Yeah, we just need to wait for that catalyst, something to happen for us to say, okay, what could that be? What is that sort of event or stat or something that can trigger the change?
I think the catalyst would be, okay, we've seen that supply out the Middle East hasn't been massive yet, but if we get another big hike, official hike, and Saudi decides, okay, we want to add another 200,000-300,000 barrels a day on top of what we have pledged already, and then summer crude burn starts to decline, and then refinery buying globally starts to represent the turnaround season in autumn, and then suddenly the whole thing can shift around very quickly. And if you start to see that flows at the Middle East are rising very quickly, that could be my catalyst, so to speak, for the narrative changing.
Okay. More bullish news as well. What else do we have? Okay. Europe and Russia price cap, STO. What do you want to talk about?
Just two more very quickly. So the STO came out, and they basically already said that US supply has peaked in April. So they made quite substantial revisions for exit production in 25. And that's one of the things I wanted to point to. OPEC are almost getting what they want already without having done very much in terms of real supply hikes. So it seems like the forecasts for US supply are still coming down. We'll see if that happens. So that's one thing from the steel. And then the other thing to mention is that there's the headline that Europe is planning to reduce the Russian price cap and maybe planning to, if you like, ban imports of refined products that were produced using Russian crude outside of the bloc, which would kind of mean basically Indian and to a certain degree Turkish refined products imports. That would be quite a big deal. So that's probably 500,000 barrels a day of product imports that would, in a way, be banned. It's very difficult to know how you would prove it, because obviously India doesn't just refine Russian crude. So how do you prove that the barrels are Russian? So there's likely to be all kinds of loopholes. But just to say, it would definitely be price supportive until such time as the market understands what the loopholes would be, or exactly what the legislation would be, and or it's a real thing and trade gets rewired, and that takes several weeks, of course, and it would just be price supportive for European gas oil, for example, and jet, until all those things are understood. So it's definitely let's say not a black swan event, but a big new problem that has entered the market, let's say.
Yeah, I mean, I just don't see how you're going to be able to prove. I mean, this is just music to the ears of all kinds of small trading houses that, okay, there's a new gimmick, there's a new game.
Yeah.
Well, I mean, it's not the same as many years ago, but still, and it's not just a matter of oil. You have this with steel, with, toys, with, people now changing the origin from China to Vietnam or to other countries, etc. This is not, I just don't see this happening, working efficiently in terms of Europe getting what they want. And you will still have these new trade flows, but it will just add an extra layer of complexity and uncertainty. But it doesn't really solve what they try to solve, I would say.
Just creating more jobs for the traders again.
Yeah. I mean, for a trader, it's, why not?
Yeah, I agree with you, but it's just one of these things that, until it's understood what exactly will happen, it will boost prices.
Moving on, light ends. East of Suez has been very, very supportive, quite a bullish market over the last weeks. We, if I recap more or less what happened throughout the year, we had that big news on China exports that I think maybe is one of the underlying stories that we don't talk about that much, but it's probably what's impacting the supply side. Then we had this sort of electroshock of Indonesia not buying Singaporean, which obviously, if materialized, had an impact on any kind of bullishness in the window, as you're removing a lot of bullets, if you want. That didn't really seem to materialize. Most traders are thinking that that's just, not going to happen. And now we're back to the dynamics of supply, no? But ultimately, we're in a market that has been rallying both on spreads and east-west. Jorge, what do you think is happening, and what can you tell us about this?
Yeah, I think it's clearly in the spotlight for the gasoline market. The traders that are replying to our market commentaries and podcasts are right now very focused on the east-west and the arbitrage economic change that we have seen about that. I think one of the main drivers are the lower stocks. We talked about it last week. The latent stocks in Singapore were in a 7-month low. Yeah, I think also if you look at the export position of Singapore, it makes sense. We are in an environment of low stocks, and if we recap what we have been seeing during Q2, we have been talking in many podcasts about a strong competitiveness of Singapore into Western market. We have talked about being very cheap into West Africa, almost competitive with an European MR. We have been also talking about Mexico, big difference, much cheaper Singapore into Rosarito than US Gulf Coast. And with this dynamic and very low stock, the market is correcting to price out Singapore export into the West. It has been translated in a very big rally, both in East-West and in Singapore time spread. We have seen a $10 per barrel rally since the end of May. So the curve right now is very, very steep. And if you compare all the main trading instruments on a seasonal perspective, if you check the seasonal view. The only ones that are clearly above the average are East-West and Singapore time spreads. So I think this clearly explains that, the market is focused there, and the market in the East is outperforming the one in the West for the last month.
So, okay, so now we're in a situation where those arbs are no longer open, everything's shut down, and we're more in a rational kind of state. But then what about the West? Can we see a materialization of that strength from Asia go into Europe, into the Atlantic, if you want?
Yeah, I think we were kind of supportive last week because we saw this uptrend in the physical components in Europe. But yeah, last week the market was very week on week. Yesterday we saw a rebound, probably also linked to a 4% increase in crude. But yeah, the market is struggling to find a rally, and time spreads and cracks are almost flat, if not bearish during the last week. And yeah, one of the main reasons, if we look at the European market, we saw that a spike on physical blending components, but then the price has corrected again. And the blending margin keeps open with very cheap ref or mate, kind of a strong gas snap compared to last month. E10 blending margin is open, E5 is open for refiners, and there are not many exporting options. Into the West, into the Atlantic Basin, US Gulf Coast has almost all the outlets. And in West Africa, we have Dangote for the first summer. So I think, as we said, we don't expect such a high levels in all the indicators like the previous three summers. On the bullish side, the RBOB arbitrage is close, but it has improved. It improved a lot yesterday. So right now it's very close to be open for spot deliveries. For July, first half of July deliveries for European blenders. So if DAR keeps improving, freight has traded also lower during the last week. So we could see some bullish signal there on the RBOB arbitrage during summer.
Well, also I would say, you were mentioning that Europe with the East-West where it is now, and I would say a relatively cheap freight, you are now starting to see arbs opening to East Africa.
Yeah, exactly. Yeah, that's a very good point. Yeah, as we said, the market is changing. During Q2, we have been talking a lot about Singapore being priced into the West. And right now, after the very strong rally in the East-West, it's the opposite. Singapore is not priced into the West, not even Mexico. And Europe is starting to be the cheapest source of supply for July deliveries into East Africa. So let's see how it goes. I think the main changes in the arbitrage during this week are US Gulf Coast being cheaper into Rosarito, and also Europe being cheaper into some places in East Africa. These are the main headlines from the ARS perspective.
So this is the sort of beginning of the ripple effect of the bullishness in Asia into the Atlantic market. Europe now threatening the AG, and now Gulf Coast having an additional outlet, a significant one. So ultimately, I mean, we started at a point where I think the Gulf Coast stocks were quite high. No, is that the case?
Yeah, they are clearly above the average in Plat 3.
Yeah, Plat 3 and nationwide. No, I think you were mentioning. No, so the starting point of this ripple effect is already stocks are high. We're not in any kind of threat. Hence, the market now being not as bullish in Europe. Could we potentially see, if this persists, a more of an end of the summer season where US and Europe are the main suppliers to larger markets, and therefore we may end up in a situation where we have a late summer bullishness?
Yeah, I think it could be, and my feeling is that many people is thinking about that. Especially, if you compare to previous, what we have seen during the last 2 or 3 years, is a very big rally in June, July for gas nav, for components, and also a strength in RBOB and EBOB complex. So the people, my feeling is that the people is wondering when it will come this year. So I think right now we are seeing this more outlets for the Western suppliers, but I see that there is a cap. I mean, we can see a rally, but I don't expect gas nav over 250, for example.
Yeah, a long way to go there. Yeah, but I mean, clearly a cap because the starting point is with cheap components, a lot of octanes in Europe, high inventories in the US, etc. But maybe the positioning, if you want, is to put let's say a call or into the late summer kind of spreads or something like that. Yeah.
I agree with that. Yeah, and if we look at the seasonal level, they are below the average, so it makes sense also.
Exactly. Okay, and LPG. We talked about the agreement to talk about the agreement that was signed with an agreement in the past. So that can only sound extremely bullish. Do we see that in the LPG market or not?
We haven't seen it in the paper like during the last days, but we have seen a change in the trade flow. After we talk a lot during the previous podcast about U.S. Gulf Coast export of mainly propane, also ethane to China, and it was translated into 5-year lows in the flow. So the flows almost stopped suddenly, and China went to buy its propane to another sources in the Middle East. What we are seeing now, the market is talking about 4 new fixtures during the last week for propane from US Gulf Coast to China. So the market is seeing a revival of this trend, and it makes even more sense to think about this if we look at the new agreement, and we are optimistic about it. So yeah, I expect this flow to recover and an impact on the paper in the propane market. And changing to naphtha, we have seen there a very big change. We have made a couple of podcasts talking about how naphtha can be bullish if China cannot get all the propane they want, because some petrochemical production have to rely on naphtha demand. And we have seen a very big change. We talk about the DR being very strongly open to the east, and right now the sales prices in the east have collapsed. So the DR right now it's not open anymore into the east, and the margin is very negative. So the product is supposed to stay in US Gulf Coast and in Europe. And yeah, and I think it makes sense if China can get all the propane they want from US again. It makes sense to rely less on naphtha for the eastern steam cracker demand.
Okay, I think that wraps it up for the latent side. Thank you, Jorge. Moving on to fuel oil. Wow, I actually met a lot of people that were saying, when are we going to hear from Hua? I want to hear more about fuel oil, because obviously this year's fuel oil story has been quite something. And every time I talk about the bullishness in fuel oil, at least the ones we've had, so there was a lot of uncertainty. There was a lot of question marks. No one really knew why, So let me start with you. Can you give us a rundown on the fuel oil market? What's been happening over the last weeks and what is worth mentioning?
Sure. Well, I mean, obviously, like the whole year we've seen a lot of volatility in fuel oil markets, and lots of these questions that we talked about before, but the last week or so it hasn't been too interesting, I would say. Week on week in Singapore, we've seen physical premium strengthen for both the low and the high sulfur, and the high sulfur is now kind of firmly back in the double-digit premiums territory, which is interesting given how just more than a week ago it was hovering in the low to mid-single sort of digit premiums. And on the other hand, you have 380 July-August spread coming down by about $2 week on week to now I think it's probably $9 now. So now you have a more sort of usual structure, which is of course very different from the big disconnect that we saw and also talked about between the physical and the paper a few weeks ago. I think we probably talked about it on the podcast, maybe the snippets that I wrote. We talked about how like physical was trading basically flat, and then the spread back then was like $17 or $18, which is like a massive gap between the two. And a lot of that had to do with like a lot of the financial positioning that we saw back then. So in terms of, I think, bunker demand, on the other hand, it is sort of like a more business as usual story where we talked to a lot of the guys selling high sulfur bunker around here, and almost everybody is just saying, demand is good, nothing too unusual, it's just sort of business as usual. And then prompt supplies on the other hand actually seem plenty as well. So there's not really any sort of spreads there. If you talk about the low sulfur end, I think physical premium around $7.50 now. Front spread has also strengthened a little bit, about like $1 or so to $5.50. Crack, is pretty much stable. Sing 0.5 July crack is like $10.50, I think. Barge crack also stable week on week. So not as exciting as we saw in previous weeks.
Okay, and do you think these are fair values, or are they? And is there any disconnect?
You can look at it from different perspectives, right? But we focus a lot on the blending part of it as Sparta, and from a blending perspective, I do think at this moment there is not that much of a disconnect, for low sulfur. If you look at the blender for the region that we're running, we're getting basically +2 without the tank cost, so roughly +6 to 7 with tank cost of 7.5 blending for the first decade of July. And if you look at where the physical is trading in window, that's around $7.50 right now. So that's +7.5. So that gives you a small but kind of usual blender margin. Spreads are also indicating similar forward blend margins for next 2 or 3 months. So, and also if you look at the break-even calculations that we run on the platform, Dangote is still workable into Singapore, but by a small $2 to $3 sort of margin. Aljo is slightly in the money in both Singapore and Fujairah with the latest cargo that traded, the other day. So really, is the point here is that for low sulfur at least, I don't really see much of a disconnect at the moment. And on the high sulfur side, sort of like a similar story as well. The blender that we run for 380 in Singapore is indicating, roughly +$11 blend cost, including tank cost for the first decade of July, and window level is like +13. So it's also not that big of there's not much of a disconnect there at the moment. So it's, again, as I said, it's one of the slightly more boring weeks that we have seen this year for fuel oil.
So you're telling me that we finally have you on the pod only to come up with some boring stuff, or what? Come on. I mean, we need to work on our timing here. Give me something here. Let me see.
There's some other stories that people talked about in recent weeks as well, and I think one of them is like the PowerGen needs. People talk
okay.
a lot about that.
There's a story on PowerGen. Tell me something. Come on.
Well, PowerGen in the Middle East and South Asia is always a big thing in the summer, right? And we did send a chart to a bunch of our clients earlier this week. So what we did in that chart is comparing the different fuel types on the dollar per megawatt hour or dollar per MMBTU sort of basis after adjusting for calorific value and also the different power plant kind of efficiencies, which frankly a lot of people kind of forget to do when they try to create these sort of charts, right? You have different calorific values, different sort of fuels, and also your gas plants have different efficiencies compared to your oil fire plants, and all those sorts of things are important. So what you see in the chart is that gas and high sulfur fuel oil, they're roughly tight right now on the dollar per megawatt hour basis, but in some places like Red Sea, I think it's tilting toward high sulfur fuel oil at the moment, but not by a massive margin, probably by a small margin. So the HSFO is a little bit more favorable than gas to some of the places on the Red Sea coast. At the moment, I also don't think that the PowerGen needs are really desperate yet. And if you look at the market, not just market, but last week, the Hajj, for example, in Saudi, we've got 1.5 million external pilgrims in Saudi for the Hajj, which is some 6-7% less than last year. And if you look at our Singapore blending tools for 180 and 380, the cost differential between the two, or physical in this case, is roughly $6 to $7 and around $9 for Fujairah. Hyper Visco is also trading almost exactly the same level. It's not, it's not a perfect sort of measure, but it's Visco is a proxy to kind of judge how demand are, whether it's like super desperate or not. And these levels are really not unusual for the summer. And there's not much of a disconnect between the physical stuff that we're running in the blender and also, versus the paper that we're seeing. So that does tell you to some extent that the PowerGen needs at the moment are probably satisfied to a good extent right now.
Okay.
Can I ask a question though? Sorry, why? Just something you said. So the number of pilgrims for the Hajj is, an important indicator of PowerGen needs in the summer. Is that true? I never thought of it.
Not necessarily true, to that, you really cannot use it to sort of put in your model and your regression, etc. Right? But it's always good to keep an eye on, whether if it's a 20 or 25% sort of change, okay, that's a big change. That's probably gonna have an impact. But if 5 or 6% change, that's really not, not something that will be talking too much about, but it's always good to keep an eye on. And yeah, because in the past, historically, we have seen when the Hajj happens in the summer, well, the time is, like it is different every year, right? So depending on the calendar, but usually that adds up to about 100 kbd, up to 100 kbd in oil burn in Saudi over the month. So that's what we have seen historically.
Okay.
I just wanted to point out, very interesting analysis that you guys did on the gas versus fuel oil on an MMTTU basis or dollar per megawatt hour. If anyone is listening and you want to have access to that, please reach out. Normally this is just for customers, but if you're interested, please don't hesitate to reach out, because it's something worth exploring, particularly in these kind of more opaque kind of arbitrage opportunities. So happy to provide. Just wrapping up on the fuel oil side, a lot of people were also talking about high sulfur fuel oil to crude switching recently, given how strong the high sulfur fuel oil has been. Is there any truth into this story?
Yeah, I think, there is definitely some truth to it, but also a lot of caveats, due to the high sulfur fuel oil switching is technically, for an oil-fired power plant is a very easy thing to do. It's almost like a one-to-one sort of direct substitution between crude and high sulfur fuel oil. But what is more complicated that people don't talk about that much is that in many parts of the Middle East, it's not exactly that dependent on prices. Like if you think about, the Saudi, for example, you have all sorts of things like crude versus the product export strategies. That usually is a little bit more important, than prices when it comes to what kind of fuel you're going to use and how much switching you're going to do between the two. So, and also we need to remember that a lot of these people are buying Russian high sulfur for power burn at a discount. So the relative pricing can vary very significantly. It's a bit more opaque than, like people, it's not as transparent as people may think.
Saudis are supposed to be they're trying to get rid of liquids burn, right, for PowerGen. That was the story a few weeks ago, but it doesn't seem like in the latest data that, like for Jody data from March, for example, that really is true yet. Is that fair to say?
Are we comparing about between gas and oil, or
we're just talking about total fuel oil and crude burn, let's say, not much lower than last year in March?
Exactly. If you take it as a combined figure, I don't think there has been too much of a big story there yet.
Yeah. I had to laugh, Felipe, because you're talking about the sort of Hua coming on and not having a good story, but Hua has it's fair to say, you have a low tolerance for talking nonsense. Like you hold yourself to a very high standard. So I have a lower tolerance for talking bullshit.
If you look at the calls I make this year, I make 5 calls the whole year so far. They all turn out to be right, but it's just like I hold myself to a very, if I don't have anything interesting to say, I'll probably not say anything.
No, I fully agree. Here we're not just, we're not here just to talk. This is, the idea is to share some insights
exactly.
and future outlooks and all that. No, I was just messing with you, but it's just the timing. Before we wrap up quickly on fuel oil, last week when we spoke with James, there was a conversation around how monsoon season probably being one of the factors driving some of the weakness in the diesel over summer. How does that affect your fuel oil outlook? I think a few months ago, we talked about how the fuel oil can potentially absorb a bit of the gas oil pool when prices are right. Are we there? Do you think there's an impact here?
It's definitely an interesting thought. Monsoon season, as you know, is starting in both India and South China. And that normally, it corresponds to some decrease in diesel demand because you've got less construction going on during the monsoon season. And in West Coast India in particular, that usually also corresponds to about, I think, 150 to maybe 200 kbd increase in diesel exports. So, but at the moment, to answer your question, I still don't think the prices are right yet, but we're definitely getting a little bit closer. So if you look into our platform, we run our break-even calculations for 10 ppm going to the fuel oil blending pool on a real-time basis. And the gap was around, I think, $3 or $4 per barrel out of the money for 10 ppm going into 380 blending about a week ago in most of the hubs that we cover. But that has narrowed down somewhat to about $2 to $3. I think in Singapore it's probably around $2.5 right now. So it's narrowed down somewhat. But really, of course, it's really not the actual on-spec 10 ppm that goes into fuel oil blending, but rather it's the other part of the gas oil pool, your LCO, some of the stuff that could go into both, like gas oil pool or the fuel oil pool that potentially gets absorbed. But right now, it does show you that there is still a value gap there before any of the absorption becomes a bit more meaningful. So
okay. Well, thanks for that. I think that wraps up our fuel oil section. Moving on to physical crude. I think the $1 million or $1 billion question, Neil, is can we justify a $1 per barrel spread?
Yeah, I wish I could answer it, but we can go through some of the things, right? And I also just wanted to update you because I didn't like not being able to answer your question earlier. So I updated the positioning data as we spoke, and it was more or less true. So we were quite short, and now we're not as short as we were. And particularly on WTI, we reduced shorts a lot and added some longs, which makes sense because we've been talking about low Cushing stocks, and basically part of this market is WTI driven at the moment, and there's clearly a problem in US stock levels, let's say. So, I mean, the question is what's been driving spreads? So I would say it's 50-50 headlines and fundamentals. A very rough, a rough kind of rule of thumb. There's all kinds of headlines. We've talked about it. I think also the catching up with the OPEC narrative has been a key one, and also seasonality is just the timing's right for that, right? So we're in the max run season. We're looking at draws, seasonal draws. US stocks are low, so it's partly driven by that. And just to add a couple of things, we know that TI is very strong. There's wildfire risk. There was another draw on Cushing last week in yesterday's data, and we're already looking at MEH spreads. That's basically the essentially the Houston versus Cushing spread. That's already very weak, and it makes sense in that prices are telling us Pad 3 doesn't want to draw more barrels from Cushing than it really ought to or needs to, right? So that's all makes sense. The other two things to think about are the fact that Dubai market is now re-strengthening. So we were talking about the potential for that to happen a few weeks ago, but it never really happened. And it kind of puzzled us. And the big elephant in the room was OPEC supply. But we kind of knew that OPEC supply wasn't rising. But finally, Dubai market is strengthening again. So I presume that's the fact that OPEC supply isn't much bigger than it was. You've got higher runs. You've had closed arbs from the West for a long time. And so that makes fundamental sense to me. And Brent spreads have risen kind of in sympathy with those things, right? On top of the headlines. So I think what we ought to do is then split up what's next into short term and medium term. So short term, a couple of ideas. I think physical Brent looks like it's pricing in a very extreme way again, because we keep on talking about this. Either it seems to be ultra weak or ultra strong the last few months, and now it's ultra strong. So if you look at the DFL, it looks ultra strong again. And despite the fact that you have a tight US market, TI is actually pricing really, really well into Europe. So it's kind of close to Asia, and it's really open to Europe, which I'm not sure it makes that much sense. And what's actually happening is you have a narrow paper WTI spread, but you have a huge DFL, and you have a weak MEH spread, and you have very cheap freight rates. So what's happening in the Afra market is global VLCC rates are absolute garbage. That is essentially dragging down kind of deferred Afra rates as well. And so the combination of those things is actually meaning that Afras, even TI Afras in Europe, now look very cheap. So what I'm now questioning is, I think very short term, that might be a driver to see Brent spreads come down again, at least bring down the DFL. And this is all X headlines, of course. If we get an Iran shooting match, it's different. But I think short term, just looking at what's happening, closed arbs to the east, very open arbs from US into Europe, that is something that maybe doesn't make too much sense to be sustained longer or for very long. So I think possibly Brent might need to have a short-term correction. That's the one thing. And then the next thing is just medium term, and we've already touched on it. Maybe I'll talk about it again in the next couple of weeks and have a more fully fleshed answer here. But I do think we've kind of had a good trade now, right? So we basically started May and said, okay, spreads are at 20 cents, doesn't make sense. And now we're at $1 or 80 cents for Brent. So eventually I'm thinking, eventually this narrative will change. And it is about things like summer burn will ease eventually. OPEC will likely hike more. Crude buying eventually will start to reflect maintenance. So we're already buying for August in Asia, eventually in a few weeks, or actually not too long. We'll start to buy for September. Eventually, European buying will reflect post-summer, and I think all those things could come together, and then the narrative will change a little bit. But timing-wise, I don't know yet, but I'm not quite sure that we can be very certain that, let's say, balances in the next 3 months will look as bullish as they have been now, because now is basically the perfect time of year for it. So that's it, really. That's a short update on crude. Make sense to you guys?
I don't know.
Okay.
I mean, it makes sense, but I'm still missing the. It sort of feels that we're back in this dynamic of those fundamentals, or that fundamental story will eventually at some point perhaps kick in. It's you see, but we still don't have that catalyst that we talked about earlier. The only difference is that obviously when you were a 20 cent spread, then okay, it was a buy. Now at one, there's a question mark. But so you might end up hovering or having a rolling backwardation, where it keeps strengthening as you go into pricing on the front month. But yeah, I'm not hearing the catalyst, if you want, for you to switch completely.
I'm not saying that I have seen the necessary catalyst yet. But like I say, it's medium term. I'm just trying to explore what's next a little bit.
Yeah.
And I can definitely see that we're basically at almost peak bullish narrative, because we've not seen the macro impacts very strongly yet from all this tariff nonsense. We have now caught up with the fact that the OPEC hikes have been basically non-existent, and it's a very nice seasonal time of year. I can just imagine, half of this is narrative driven, and I can imagine that the narrative can start to change as soon as you start to see, oh hey, look, Saudis are actually started to export a lot more because burn is over, and they've hiked supply again in July, August, which they're planning to do. And the Saudis are basically the only ones that will hike, or one of the few ones that will hike the most. And then on top of that, maybe the margins will change. So we are seeing, US gasoline stocks relatively high, a few more bills in distillates. The margin picture already looks quite a bit weaker than last month. So if you look at European cracking margins, they've come off by 50% basically in a month. So they were kind of like $8, now they're $3-4. The simple margins are negative again. So the margin picture is changing. That could be one catalyst.
Yeah, fair enough.
Yeah.
No, that's a good one. Yeah, that maybe it's true. Yeah, we had a very strong margin environment on top of all the stories and all that, which is not necessarily the case anymore. It's still good, it's still positive, but it's not as good, and it's something to keep an eye on. Yeah, I'm just mindful of time, guys. Distillates. Let's move on to distillates. Neil, last week we discussed, James was sort of getting a feeling that getting a bit short ICE Gasoil, July, August spreads. But I think I remember that you were not so convinced at the time. What's your opinions? And now that James is not here, maybe you can take over the narrative. Yeah.
Yeah, I'll take over my own narrative. Perfect.
Yeah.
No, I'll still just basically, it's a brief update, but I'll still say the same thing. Let's say I'm not quite convinced yet. So James is perfectly right. The June expiry is proving very strong, and I think trying to understand why that's the case is relatively easy. Let's say so. There've been lots of refinery outages in Europe. We had the Spain story, which lasted a long time. Arb econs into Europe have been relatively poor for quite some time already, so it kind of makes sense to us. Now the question then becomes July, and I think part of James's theory was that we're going to see more builds in the US because that's the time of year for it, and the Arb econs will change. But I just wanted to say a couple of things about that. So if you look at the kind of rolling front month Arb econs from both Houston into Europe and Sika into Europe, the thing hasn't changed very much. In fact, the sort of US econs are worse than they were over June. And in late May, it looked like, Sika barrels were going to start to point west, but now it's basically a very short-lived signal, and it's pointing east again because the Singapore market looks stronger in a similar way as the gasoline market, right? So I think my thinking is that, split this up into a couple of things. It's normal for US to build product at this time of year in June. If you look at the seasonal chart of it, it's completely normal, and we're not off track from that perspective. So for me, that's not a warning sign. and it's come at the expense of crude stocks, right? So we're not getting huge oil builds in the US. We've got massive runs in the US and it's drawing crude, and we're not building distillate stock at particularly unseasonal rate, right? So I think that's kind of normal. And we're building from low levels as well. And then from the ARB perspective, Sika is now pointing east again, as it has been on average for quite some time, by quite a long margin. The US ARB is getting worse. The Brazilian premia are rising again, and that should draw some volume south. And so I think, I agree with James in that there could be a change of narrative, let's say, for ICE Gasoil. But I think what we need to see is a couple more bigger builds in the US, bigger than normal, let's say. And we want to see the econs change. So we want to see the Singapore market weaken. We want to see the East-West widen out again. We want to see the HOGO come off, because the HOGO is still remarkably strong. And so I would still think I'm not ready to really short July, August ICE until those things really happen. So I think that's basically my thinking still. And everything has to go right.
We also talked about the monsoon just now, which is an important thing in India and South China. You've got less demand in both places in terms of construction and stuff. And I think also the Chinese refineries are coming back from turnaround. So normally you would probably have that could probably contribute to some weakness in the Singapore market as well. So to be something that Jem was probably thinking about that. But it's your narrative now.
No, but that's fair enough. But the Chinese one is wait and see, because it depends on what you read. Like, Chinese product stocks are supposedly low, and it's the crude stocks that they've been building. So I don't know. It depends on the econs a bit. In India, you tend to see the export rise in July. So you have to get there first. So again, those are things that would weaken the Singapore market, and we've just said that the Singapore market looks stronger than it did. So it hasn't looked like it's had to absorb extra barrels yet. So yeah, I fully agree, that will happen. But at the same time, Indian exports rise in July, but you get a big spike in jet demand everywhere. So, it kind of helps to balance things out. So if we're just talking about price, I want to see the Singapore market weaken first. I had one other thought, but yeah, that's it. I wanted to say everything needs to go right refining wise, right? So if you look at US runs, they're absolutely massive. And when that happens, I have to say the only way is down, because something will hiccup, something will explode. We're basically at peak US runs now, and the same might happen in Europe. And then, that tends to help you.
Okay. Anything else to add? Or maybe, those trade deals, European, banning Russia, that's sort of like the wild card, but something to keep an eye on. But otherwise, just with things that are more or less under control, I think that to wrap it up, I would say East-West to widen again and the HOGO to come off. But as you said, keep an eye on the refinery runs. Okay, well, I think that summarizes everything, guys. Thank you so much. It's always a pleasure to see you. For those who know James, he just had a baby. So if you want to congratulate him, don't hesitate. And thank you so much, guys. And I'll see you next week.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.